All right, Elaine, we'll see you soon. Thank you very much. Back to our top business story. The Federal Reserve says it will continue an $85 billion a month asset purchase program despite improvements in the U.S. economy. The Fed still sees unemployment as unacceptably high and is sticking with its current stimulus plan.
Yes, what the Federal Reserve Chairman Ben Bernanke has said today and conceded is that the Federal Reserve is continuing its journey into uncharted territory without knowing exactly when it's going to stop and under what conditions. It's one of the brightest outlooks for the U.S. economy since the financial crisis began, with America's central bank being encouraged by improvements in the housing market, consumer spending and business investment. So why is the chairman so reluctant to close the stimulus taps?
So we've seen periods before where we had as many as 300,000 jobs for a couple of months, and then things weakened again. So I think an important criterion would be not just the improvement that we've seen, but is it going to be sustained for a number of months?
The Fed sees price rises at the gas pump as temporary and doesn't see a risk of inflation rising above the 2% long-term U.S. target anytime soon. But there are concerns among members of the central bank's Federal Open Market Committee that makes key decisions about U.S. interest rates and money supply. Some committee members say the Fed's cheap borrowing policies encourage risky bets and a bubble mentality in some financial markets.
There's a wide range of views about how effective asset purchases are in terms of moving the economy. So as we move forward in time, we'll be learning about how effective the policy is and what costs and risks there may be associated with it.
The Fed says it will continue to hold its target interest rate at near zero until unemployment, currently at 7.8%, dips below 6.5% or inflation rises above 2.5%. But if that rate does go up, most members of the committee perceive it to go up or predict it to go up in sometime in 2015. But it's sure that if growth rates continue at the current rate, then the current spending spree of the Federal Reserve will end way before then. Back to you in the studio.
All right, Daniel, thank you very much on that. For more on this topic, we have our panel discussion now. We're going to see if the plan by the Fed to keep supporting the U.S. economy is going to really work. Daniel Hanson from the AEI, American Enterprise Institute, and Warren Coates, former IMF and monetary policy expert. Thank you very much, gentlemen, for both joining. I guess the simple question is, the Fed didn't really have any surprises. It was pretty much as is. We know about all the different QEs, and it appears to have worked thus far because unemployment is dropping. Do you think that the Fed is happy with the progress?
Well, I think that the Fed is at least confident that what they're doing is the best sort of possible choice they could be making right now. So it's not that they would obviously enjoy more progress. They'd enjoy for the unemployment rate to be falling more. They'd like it if the inflation numbers looked a little bit better. And certainly they'd like it if the international environment would cooperate with their plans. But what they see right now is okay for what they're doing.
Warren, did the Fed make the argument to continue the current policy of not just the bond buying, but everything altogether, what the Fed has been trying to do?
I think the Fed is trying to do what the Fed can't do. The sluggishness of the economy is not a result of overly tight monetary policy. It's Congress, policy uncertainty, the debt problem, and so on that is keeping investors from wanting to invest. They're sitting on piles of money, and for the Fed to pump more in doesn't help, and it only creates problems down the line.
It's ironic that we're all physically here in Washington, D.C., yet you cite one of the problems is Washington, D.C. There's a lot of people talking about when does the Fed shift gears. If they've got this very accommodative program right now. We can argue about whether it's correct or not, but it's already in place. When does the Fed shift gears?
They have, in their very transparent way, and I give them credit for being one of the most transparent central banks in its history and among other central banks, made very clear the conditions under which they will begin tightening. I think they ought to change those conditions a bit and move up the baseline from the zero interest rate policy. It's distorting investment in the economy.
Daniel, do you think it's time to start talking about tightening, or is it too early?
I think it's too early to start talking about actually tightening, but I think it's not too early to start articulating an exit strategy. The exit strategy that they're going to have to use to unwind their balance sheet is something that's probably still a year or two away. But to let markets know what their plan is would be very, very wise. The last time they talked about unwinding their balance sheet in serious terms was June of 2011. It's gotten a lot bigger since then and a lot more complicated since then.
There's two big numbers here, and for our viewers around the world, we've got the two large numbers, which is one, unemployment. The Fed says 6.5%. That's what they'd like to see, or lower, obviously. The other one is inflation, 2.5%. And I think I know the answer to this. I mean, it seems somewhat reasonable because it's not attainable at this point, but do you think it's a reasonable situation to have these near 0% interest rates with basically very little inflation?
I think near zero interest rates are not a good policy. I think the forward advice the Fed has given of when they would tighten is reasonable, but I think they should raise the baseline. They're continuing, we're talking about when will they start unwinding their balance sheet. They're continuing to expand it. That's not helping the economy. It's only making their exit more difficult. They could stop that now.
Daniel, these two targets, the inflation, the unemployment, I mean, there's a lot of debate about this out in the economic world about it. But to the average American, to the average person sitting watching television, you know, for them, if they have a job, they're fine with it. They don't really notice it. Inflation appears to be benign at this point, so they're not really that concerned about that as well. Is the Fed focusing on the right two? Are these the two numbers the Fed should be focused on?
Well, they're the two numbers that the Fed can focus on. The Fed's mandate gives them the opportunity to pursue price stability and low employment. It doesn't really give them a purview beyond that. And those two headline indicators are the best sort of gauges that they can pull out to say, this is what's going on in those markets. I do think that people at home are probably concerned because their 401ks and so on are getting hammered by low interest rates. And particularly people on fixed income like senior citizens are really having a tough time with even small inflation when their fixed income is smaller than it ought to be.
People always ask, and when we talk about the Fed, it's a complicated scenario. And essentially, for lack of a better word, they say, why should I care about what the Fed is doing? If I'm sitting in Hong Kong, if I'm sitting in Beijing, if I'm sitting in London, why should I care about what the Fed is doing? And there is an interesting discussion about it because when the U.S. keeps rates at zero, it affects the currency. Mm-hmm. It affects commodity prices around the world. Do you think commodity prices have been inflated, and by how much because of the policy? I know it's a hard question, but I mean, this is the elephant in the room that the international investors has been asking this question.
I would say yes, but I wouldn't venture a guess of how much. But I would like to say that I agree with everything that you just said. I think the problem is expecting from the Fed more than it's possible for a central bank to deliver. The most serious problems are not with the central bank.
Mm-hmm. So if you had a chance to speak to Chairman Bernanke, and you could talk about, say, hey, we've got this discussion, welcome to the show, we'd like to give you some advice on what we think you should do that would be good for the economy. What would be the top one or two things each of you would like to see Ben Bernanke do?
Well, I think...
I see you smiling, so we're going to get to you in just a short bit.
I think that Chairman Bernanke understands that he's sort of the only adult in the room when it comes to DC policy discussions, and that he's dealing with a Congress that's shown an intractability and an inability to resolve its fiscal problems. He's been pretty vocal about that over the past few months. And what I would say to him is that you should sort of end some of the experimental monetary policy. It's not doing enough. And just go back to what you know works, and go back to what the Fed can do, what they've done historically for the past, say, 25 years.
Warren?
Disappointingly, I agree with that also. They should stop buying mortgage-backed securities. That's a fiscal or a quasi-fiscal activity. I mean, supporting a particular market rather than markets in general. In the long run, it will jeopardize their independence because having crossed that line, Congress will look to them to continue to do things in that area.
Gentlemen, we will send an email to the Federal Reserve on your behalf. Thank you very much for your advice and your analysis on this meeting from the Federal Reserve. Daniel Hanson from the American Enterprise Institute and Warren Coates, former IMF monetary policy expert. Thank you very much.